Hey, traders! Let's dive into the Forex market update for the week of January 20th to 24th, 2025. This week saw some dramatic moves, especially with the US dollar. The greenback faced its sharpest weekly decline in over a year, shedding 1.8% against a basket of major currencies. This significant drop came on the back of dovish rhetoric from President Trump, which sent shockwaves through the markets. During a series of public appearances, Trump hinted at a potential rollback of tariffs on China, signaling a softer stance on trade tensions, a move that traders interpreted as a step toward de-escalation. This was a major shift from his previous hardline policies. At the same time, he called on the Federal Reserve to take action by cutting interest rates to stimulate economic growth, adding fuel to the sell-off in the dollar. The market reaction was swift, with currencies like the euro and British pound gaining ground against the dollar. The euro surged by nearly 0.9% for the week, benefiting from both dollar weakness and improved economic data out of the eurozone. Meanwhile, the pound posted modest gains of around 0.3%, supported by renewed optimism surrounding the UK's economic outlook. But that's not all. The ripple effects of Trump's comments extended beyond the G10 currencies. The Mexican peso climbed 0.6%, riding on hopes that reduced US-China tensions could boost global trade. Risk-sensitive currencies like the Australian and New Zealand dollars also rallied to 5-week highs, capitalizing on the improved risk sentiment in the market. This sharp dollar weakness and Trump's remarks have left traders wondering, is this the start of a more sustained policy shift, or just a short-term market reaction? As always, stay tuned for further developments in US policy and central bank decisions, as they'll likely dictate the next moves in the currency markets. Another key highlight from the week of January 20th to 24th, 2025, was the bold move by the Bank of Japan, which caught the attention of Forex markets worldwide. The BOJ raised its short-term interest rate by 25 basis points, bringing it to 0.5%, a level not seen in 17 years. This decision came in response to surging inflation, with Japan's December core CPI clocking in at 3% year-over-year, the fastest pace in over 16 months. This marked a significant shift for a central bank that had long been associated with ultra-loose monetary policy. The market reaction was swift and decisive. The Japanese yen appreciated by 0.4% against the US dollar as investors recalibrated their expectations for Japan's monetary policy trajectory. This rate hike not only strengthens the yen but also signals the Bank of Japan's intent to gradually normalize its policy stance after decades of deflationary pressures. Market participants are now closely watching BOJ Governor Kazuo Ueda's signals on what might come next. Many traders anticipate further rate adjustments later this year, as inflationary pressures show no signs of cooling. This move also positions Japan as a more attractive destination for foreign investment, as rising interest rates could bolster returns on Japanese assets. The BOJ's decision adds a new dimension to the global monetary policy landscape, especially at a time when other major central banks are grappling with their own inflation challenges. This shift in Japan's policy could have far-reaching implications for global currency markets, especially for the yen crosses like US dollar to Japanese yen, euro to Japanese yen, and pound sterling to Japanese yen, which will be worth watching closely in the weeks ahead. In other part, the unexpected upside in the eurozone this past week, which played a significant role in driving the euro higher. Economic data revealed surprising growth in business activity across the region, which caught markets off guard and injected a dose of optimism into investor sentiment. This unexpected rebound came from key sectors showing resilience, particularly services, and it highlighted the eurozone's ability to weather recent economic challenges. Adding to the positive mood was a wave of improved corporate earnings, especially from luxury goods companies that reported strong performance despite broader concerns about consumer spending. This bolstered confidence among investors and further fueled the rally in European equities. Meanwhile, speculation is heating up over the European Central Bank's next moves. Traders are increasingly pricing in potential rate adjustments from the ECB later this year, as inflation and economic growth dynamics remain in focus. While no immediate action is expected, the tone from policymakers will be critical in shaping market expectations. As a result of these developments, the euro gained significant strength, with euro to US dollar surging to a 5-week high, outperforming many other major currencies. This marked a nearly 0.9% weekly gain for the euro, as it benefited from a combination of dollar weakness and renewed confidence in the region's economic outlook. The euro's strong performance underscores how shifting sentiment in the eurozone can create opportunities in the forex market. Keep a close eye on future ECB policy signals and economic data from the region, as they will likely set the tone for the euro's trajectory in the weeks ahead. One of the standout movements in the forex market this past week came from the Australian and New Zealand dollars, which both saw a strong rally thanks to a shift in risk sentiment. The catalyst for this surge was a series of comments from President Trump about possibly reducing tariffs on China, which sent a wave of optimism through global markets. Investors began to anticipate that a reduction in trade tensions between the US and China could lead to a smoother global economic environment, and this lifted demand for risk-sensitive assets, including commodity-linked currencies like the Australian and New Zealand dollars. As a result, both the Australian dollar to US dollar and NZD/USD pairs hit their highest levels in 5 weeks, gaining ground on the back of this newfound optimism. The Aussie and Kiwi dollars benefited not only from the reduced trade tensions but also from stronger-than-expected economic indicators out of both Australia and New Zealand, adding fuel to the rally. These currencies are often seen as barometers for global risk appetite, and with the shift toward a more positive outlook, traders were quick to jump in. In addition to the Aussie and Kiwi gains, the Chinese yuan, CNY, also strengthened in response to the potential thawing of relations between the US and China. Investors are hopeful that these trade talks could lead to better trade terms and overall stability in the region. With China's economy being such a major driver of global growth, any positive news on trade can have significant ripple effects on currencies tied to the Asia-Pacific region. So, in summary, the combination of Trump's tariff comments, improving sentiment in global markets, and the positive data out of Australia and New Zealand created a perfect storm for both the AUD and NZD to outperform other major currencies. Keep an eye on how the US-China trade negotiations unfold, as further developments could continue to drive these risk-sensitive currencies higher. Aside from the major currency movements this week, there were some other significant market shifts that are worth noting, particularly in the commodities space. First up, gold had a strong performance, climbing 2.7% as the US dollar weakened and geopolitical uncertainties continued to loom over the markets. Gold is often seen as a safe haven asset, and with the dollar on the back foot due to President Trump's comments and ongoing global tensions, investors flock to gold as a store of value. The price increase in gold reflects both the dollar's decline and concerns over potential global instability, making it a key asset to watch for anyone interested in safe haven flows. On the other hand, crude oil saw a slight decline this week. Despite hints from OPEC+ about potential supply cuts to support prices, concerns about global demand weighed heavily on the market. Traders are still uncertain about the sustainability of global oil demand, particularly as economic growth in some regions faces headwinds. This led to a slight pullback in oil prices, even as OPEC+ indicated they may cut production further to stabilize the market. The balance between supply control and demand concerns will likely continue to shape oil prices in the near term, so any updates from OPEC+ meetings or global economic data could trigger further volatility. Overall, while gold is benefiting from risk-off sentiment, oil remains under pressure from a mixed outlook on demand, making these commodities important to monitor as they could influence broader market sentiment and currency movements as well.